Hi, this is Ashish and I am happy to present to you key highlights of the Feb version of our monthly publication Alpha Strategist. It's been a busy couple of weeks. On 1st February, the government presented its interim budget. It needs to be voted once the new government comes to power. So there was a lot of fear that this government could go overboard in terms of subsidies, especially to the farm sector, and that could hamper the fiscal deficit number. However, the government delivered a 3.4% fiscal deficit number, which the market took in its stride, because the fear was that this government might actually widen the fiscal deficit and there may be a lot of giveaways to the rural sector in the budget. However, the government chose the direct benefit transfer route, where they said that for small farmers who own less than 5 acres of land, there will be a benefit of 6,000 rupees every year, of which 2,000 would be paid out this year itself. Now, this will dent the finances of the government by close to 75,000 crores. Now, this was not as bad as what the market had expected. The market thought that it might go up to 1.2 to 1.5 lakh crores. So the government did a fine balancing act by managing to contain the fiscal deficit at 3.4%. But the natural fallout of this balancing is the capital expenditure part of the budget. So next year, the capital expenditure is growing only 6%. Now, what happens is typically when capacity utilization in the economy is low, as it is right now, it's closer to 75-76%, the private industry doesn't do capital expenditure. Then the onus of capital expenditure shifts to the government. Now, due to the constraints within the budget, the government will not be able to increase capital expenditure by much next year. I mean, in fact, the number is closer to 6%. Now, this will obviously weigh on capital goods sector as well as domestic cyclicals, and it will also have some bearing on growth going forward. This was followed by the RBI policy. The expectations was that RBI will move from calibrated tightening to neutral or maybe even dovish. There was a small probability of a rate cut. RBI actually delivered a rate cut, and the reasons for the rate cut were cited as persisting low inflation. The last number which came in was 2.2%, and RBI has also revised its forward guidance on inflation downwards, and this is rightly so in line with what is happening in the economy. However, having said that, we don't believe the transmission of this rate cut is going to happen immediately, because the money markets are tight. It's not awash with liquidity, and the credit spreads are still very, very high. So after the ILFS fiasco, a lot of NBFCs and a lot of other financial institutions which are not AA rated or which are not from a strong parentage have found it difficult to borrow. So the absolute yields are pretty high, and the real yields are also very, very attractive. So for fixed income investors, we basically continue to recommend them to buy high quality AAA portfolios with average maturities of between 2 to 4 years. Now, these portfolios are yielding closer to 8%, and after 3 years you also get a tax benefit. So it is very attractive, and we recommend you to lock your fixed income money right now. On the equity front, we do believe that the next 3 to 6 months are going to be quite choppy, and it is going to test a lot of investors' patience as news flow constantly keeps building expectations. One is on global developments as to how global trade is reacting, the interest rates, how they develop, albeit the US Fed has indicated that they're going to go slow on any further rate hikes, because the recent data in the US came in quite soft. However, there are murmurs about Chinese economy slowing down and the debt building up. So these news flows will keep markets on edge. Similarly, the government formation and the speculation about which party is going to take power will also keep the markets choppy. However, the good news is on the earnings front. I mean, we've already seen quite a few companies declare earnings. In fact, 34 out of the 50 Nifty companies have already declared earnings, and about 70% of these companies have either met or exceeded analyst expectations. And this is data that we are seeing after quite a few quarters. So visibility for earnings growth, at least in India, remains very, very high going into the next fiscal year. And a lot of the sectors or companies which actually dragged earnings down over the last couple of years are expected to drive incremental earnings growth. So for example, corporate banks like ICICI, SBI, Axis, which were saddled with high NPAs and were bringing down profitability for the sector, are going to drive profitability for this sector in the next fiscal year. So our earnings estimates remain more or less stable. I mean, this year we're looking at a 508 earnings for the Nifty. So you're trading closer to about 21.5 times trailing, and we are looking at a 640 number for next fiscal. So valuations are not very expensive, and in fact forward valuations look cheap because of the high earnings growth expectations. The small cap, mid cap segment have fallen quite sharply. In fact, a lot of stocks are down more than 40-50%. In fact, we have an interesting table in the Alpha Strategist this month which tells you that about 90% of the FNO stocks are down anywhere between 10 to 90%. This is from 9,000 levels of Nifty. So few stocks have taken the Nifty up, but a large section of the market is down brutally. So that's what is probably reflecting in your portfolio performance as well. We also give a message on how to build an investment charter. Remember, we started this year with the theme of Year of the Charter, and we further build on that this month, and we've given a format of how an investment charter looks, and because we believe that's the best way to stay disciplined and have a framework around your wealth management process to ensure that your investment outcomes reflect what you expect in the future. So we've given a nice table which shows you equity returns across funds as well as indices from 2005 to 2018. This is a 13-year journey of an equity investor where you've seen compounded growth rates in equities ranging between the high 50s to as low as single digit 3% kind of CAGRs. What this basically tells you is that whilst you're investing in equities for 5 to 10 years and your expectation from equities could be anywhere in the region of 15 to 18%, this journey is not very, very easy. It's a very arduous journey where there are periods where you have to see negative returns on your portfolios. And if at that point in time you get frustrated or you lose patience and you redeem, you tend to lose out the benefits of high return years in equities. So I think this is a period which is going to test your patience. A lot of the portfolios that we built may not be looking as good as they were looking probably a year and a half back. But that's how equity markets are, and I think one needs to patiently go through this period. At the margin, actually, you should be looking to add capital to equity strategies which have fallen much more than other strategies. So we believe that this is a time to stay the course, look at your investment policy, the framework, check whether your asset allocation is aligned with your long-term expectations and outcomes that you want on your portfolio. And I can assure you that these periods will pass, and you will get the investment outcomes that you desire. So thank you very much for listening.